So now we're going to turn to the export market and what's happening in the US into the export market, and what does the international world really look like in terms of movements of products as well as differentials. So here we're going to look at just what has happened with the US so far. We were expecting another little bit of a decrease in gasoline exports. Instead, we had an increase of about 60,000 barrels. Distillate, we were expecting kind of this steady walk down. It was the decline of 47,000. The biggest one was propane, LPG. Small walk down of 263,000 barrels a day. Still well over the 5-year, continuing to be strong. The one that we're going to look at the most is really going to be crude oil exports, which only declined 233,000 barrels. That's one where we think there's going to be additional pressure coming into the market. We went from about essentially 3.88 million barrels a day to 3.65, and that's where we continue to see some of these headwinds in terms of flow, not just on timing, but also just in terms of spreads and what makes the most sense given where some of these flows are. Now, when we look at gasoline, there's some caveats within that. So the U.S. Gulf Coast has had a lot of naphtha. So we've generated a lot of naphtha just based on we've increased refiners. We don't need the naphtha to the same level. So what do we normally do with that? We typically either crack it and add it into the gasoline pool through octane or blending stocks. But just given where we are on blending stocks, it has to go somewhere. So here, when we look recently, as refiners are running hard to meet rising local gasoline demand, at the same time, demand for the blend stock from Latin America, which accounts for about 50% of all naphtha exports from the Gulf Coast, has been weak just due to the weak gasoline consumption and the mobility restrictions. So now our normal end market just doesn't exist in Latin America to the level that it normally does. So we're sitting on this excess that is really kind of getting blended into this gasoline pool or this light distillate pool. But at the same time, buyers in Asia have been unable to take all of the barrels offered by the U.S. as lengthening supplies in locations such as India, the Mideast, and Mediterranean are more competitive due to their shorter voyage time and relatively cheaper freight, according to Energy Aspects Tyler. Now, the naphtha being sent from the U.S. to Europe is mostly blending stock, which is mixed with gasoline. So when you look at what is being exported, it's technically naphtha into Europe, but it's classified as a blending stock or gasoline. So it's going to come down to, well, what is actually being exported? Is it gasoline, or is it going to be sanctioned as naphtha? And that's where we get some of these caveats. So there's not enough demand for such naphtha in Asia, where crackers mostly import light virgin and heavy full-range grades for producing petrochemicals. So again, this is where we have this blended side, which is going to get sent into Europe, where depending on classification, so that's why there's some noise within this number in general. So then when we look at naphtha surge, Europe's naphtha inflows from the U.S. in June to be the most since January 2016. And again, they're looking to just make the cheapest product possible. And just given where Urals are and where the opportunity is to import naphtha, we're continuing to see some of this flow into Europe. Now, when you look at what is happening with spreads, Brent versus Dubai, WTI versus Dubai, West Africa versus Dubai have just exploded, which is, again, you're going to go elsewhere to get your different cargoes. So just given the distillate cut from West Africa and some of these different shifts, there's no reason to take WTI when you can go get Mediterranean, either Mediterranean, West African, or the Middle East at essentially a discount. So again, this tightness in spreads within the U.S. is going to be a headwind for future exports over the next few weeks, which again is going to just push more back and into storage, which just given timeframes, we're still going to draw crude. It's not going to be at the same pace given where some of these export-import dynamics sit. Now, this is just looking at it differently. So Brent is more than $4 more expensive than Middle Eastern Dubai crude. So again, if you have the opportunity to buy one or the other, this is where you're starting to see some of these shifts. And when you look at what is being exported, you're seeing that acceleration of exports. You're seeing more of that get pulled through. And it's just because it's more competitive. And if you're not taking Brent, you're not taking WTI, you know, you're going to take West African, you're going to take Middle East, and we're starting to see some of the Nigerian spreads not really get stronger, but at least continuously stay at the same level. They got a little bit cheaper last week, and now they're really holding this line, and we're starting to see a little bit more movement of cargoes, and it's really coming down to this backdrop on strengthening of WTI and Brent, and especially based on the U.S., we're going to continue to bring in some of this excess or some of the additional distillate cargoes coming into this market. So then when we look at gasoline exports, you know, gasoline exports, it's still elevated. You can see it's below these peaks. We're going to make a higher low, a lower high. But again, we think it's going to continue to drift a little bit lower, but just more of a sideways move versus a continuation down. And that's just given the dynamics that we're seeing with Europe and some of these different shakeups in terms of flow. But then when we look at disti, this is the one that, again, is going to be more of a sideways move just because we still have a lot of product coming in from Asia. Fujairah had a big build. So there's going to be this excess product that's going to have to try to find a home. And a lot of that product is going to take our market share from Europe, Latin America, and we're already seeing that. Now, given there still remains restrictions within Latin America, that's going to continue to weigh on where some of this distillate continues to go into the market, which is also going to increase or make those increases in storage a bit stronger. So then when we look at crude oil exports, you know, we're back within this high point, but we were expecting a bigger drop down into this level. But again, we're staying elevated here, and that's where we continue to see some of this pressure to the downside. Now you can see there was this big drop off, you know, going into the week of July 4th. And we think there's going to be some of that additional drop off, which again is going to push itself back into our storage. Now, when we look at the 4-week rolling average, you can see that we're still staying at this high level of about 3.25 million. This is where we think there's going to be a little bit of a rollover, and we'll start to see that come down. But just given how strong the last few weeks are, it's going to take time to see us come back into this steady level that we've been at since you know, at the beginning of the year, you know, closer to that 2.8 million barrels a day. So then when we look at propane exports, you know, we did get a drop, but it still remains a seasonally adjusted all-time high. That's going to remain the case. That's going to continue to be elevated in general. So just because even though we have some of the naphtha breakdowns, there still remains an arbitrage. There still remains some ability to send this into the Asian markets. That is just going to come under more pressure as naphtha prices itself in, just because now as guys are long naphtha, that'll bring prices down, which is going to, again, increase those runs. So then LPG is going to have to come down in price in order to kind of, you know, balance out and weigh against some of these flows. Now the ARA, Genscape, when we look at crude, you know, crude had a fairly big build, which is, you know, kind of what we were expecting. In terms of just moving along this 5-year average, you can see that we typically have a build. We had a nice draw. Now it's just going to be this timing. The pipeline is back in operation, or I should say will be back in operation by the end of this week. These things, are just going to be timing as to when does it go from point A to point B. And we did get a drop, some drop in storage, offshore storage, so it comes into the tank stocks. Now, when we look at flows in general, hasn't been much change. You know, you can see Angola has essentially moved things into August. You know, August is going to be a bit over 1 million barrels a day. Really nothing to say in general when we look at Mediterranean. When we look at the UK has actually taken some of their July estimates higher. Which again is nothing crazy, just because some things will be coming back a bit faster in terms of where things are. As they come back a little bit faster, it just means that there's going to be more capacity to come through and into the market on the med side. So then when we look at some of the flows that we've seen so far, Vital offered 950,000 barrels of Gabon's Robbie Light crude, 75-cent discount to Brent, which was previously a 40-cent discount. SOCAR offered CPC blend at $1.90 discount, where it was initially $1.70. So when you just think about some of these moves, again, we had them try, look, let's put the bid up here. Let's put the offer up here, see what hits. And we're starting to see that walk back. Urals cross for $1.60 below dated Brent. Right now we have some Total bid 100,000 tons of Urals for $1.55 discount, was initially $1.40. Nigeria is still they're starting to see some of those cargoes move, but you can see that August is already starting to bleed out in terms of what's getting out there. So they're trying to find some of these spreads to help out. So when we look at just where some of these flows are in general, so let's keep going. So now when we look at Russia, so Russia, ESPO, Siberia, and Sokol from Russia's Pacific coast remain over the Dubai crude benchmark, which has hit the highest level since 2020. So we're still seeing, again, that demand just given where things sit. Surgut sold one cargo of 100,000 tons of Urals at a discount of about $1.40. So right now where we're seeing, and as we said in segment 1 and segment 2, the shift is to that distillate rich side. So Bonnie Light, Brass, they're starting to see a bit more of a bid into Northwest Europe than the normal kind of light sweet grades of North Sea Med, which is why we're going to see some of these shifts, and we're starting to see a little bit of a better bid out of West Africa, and not so much in terms of spreads, but just in terms of flow. And we're seeing a bit more excess coming into the northwest side of the North Sea Med, and Urals are coming under that pressure. And we're still getting some buying interest for West Africa from China. India is curbed by the Gulf and the Brent Dubai spread, which is at its widest since September 2019. So again, these spreads or these movements in these curves are just essentially shifting a lot of these flows. So now Vital sold 100,000 tons of Urals to BP, $1.60 less Brent. Dated Brent was $1.40. So again, these are those different pieces that we're seeing in terms of shifts, where SOCAR offered 85,000 tons of CPC blend for $1.90, which was unchanged from Tuesday. So we're seeing, again, the spreads are fixed at these points. We've seen some declines. It's just, this is looking at spot markets, because right now a lot of these spreads that we're seeing tighten up are time spreads, which we'll talk about in a few minutes. So when we look at inventories, light distillate had a drop, middle and heavy had some builds. What is it in general? So the total stock fell 843,000 barrels, down 3.6% week on week, which contrasts last week's build of 1.135 million, or 5.1% increase. The total stocks fall was mainly driven by light distillates, posting a 23.7% week on week draw. In contrast, middle distillate had a build of 6.6% and 4.7% respectively. So light distillates, the gasoline, naphtha side, we had a big build. Now we had a draw, but the build and draw, you have to appreciate kind of where we sit right now, because the gasoline market east of Suez remains under pressure, with a combination of demand side concerns weighing on overall sentiment, coupled with the anticipated buildup in gasoline inventories in the U.S., adding to those headwinds. So we did get some spot movements, but we're seeing those headwinds in Asia, and then the fact that, can we really continue to come into the U.S. market, given where storage is versus historics? Obviously, you have to, outside of 2020, to try to see where some of these cargoes are going to go. And again, there's still enough demand or expected demand or spread available to still see some of this coming into the U.S. or at the Atlantic Basin. It's just starting to slow down a bit. So then when we look at the middle distillate, including diesel and jet, rose 263,000 barrels to the 4.256. Gas oil market east of Suez has been lackluster due to the resurgence of COVID in Southeast Asia and India. Furthermore, refiners are expected to maximize their gas oil output over its co-distillate jet fuel due to the widening regrade, the spread measuring the premium jet fuel commands over sulfur. So again, that's where, because there remains that pressure in jet fuel, that there will be that excess disti, which has been coming into the European markets and putting more of a headwind on the U.S. Stocks of heavy resid, including fuel for power and bunker, rose 582,000 barrels to almost 13 million. Market participants said bunker demand in Singapore and Fujairah has tapered off, and they were limiting their buying to the minimum required volumes on a prompt basis due to the rising flat price. this is where we're seeing some of those slowdowns, and some of the cooling demands have slowed a bit in the Middle East. Some of those refiners that had some hiccups are now back, and that has adjusted some of those flows in general. So then when we look at global crude oil and water, this is where we're starting to see some of those increases. You can see it's still below the 5-year average, but moving up within that trend, because we are seeing some of this some of the increases in general when we're looking at just what is in motion, what is moving. So there's some decent increases on crude in transit. So then when we look at crude in transit, here you can see that we're making a higher high. Do we typically get this spike this point in time? So it's not crazy to see these moves. It's still a bit depressed, but we're starting to make some of these headwinds. So you're having things go from either storage or loading into transit, and that's putting more crude on transit and taking some out of storage in general. So then when we look at crude oil on floating storage, you can see that we came back down. We're now to between these 2016, 2017 levels, which was during, again, that market share fight with OPEC. So it's still elevated, but obviously well below where we were in 2020. And this is where we think that things are going to remain a bit flat within a fairly tight range here, just as things go from transit back into storage, and we still have those massive delays across the Asian markets. So then when we look at builds within Europe, you can see that we had these big builds in gas oil and fuel oil. We had some nice draw out of gasoline. That's the one where we continue to see some of these shifts, and the gas oil fuel oil market is really what's coming from the Asian markets. We expect to continue to see some of those builds. Naphtha is going to continue to move higher, as well as some of that gasoline, as you get some of those shifts from the U.S. into their market, and it's moving gas oil closer to that 13-year average. Now, when we look at gasoline, you can see that we've had a nice drop off. A lot of this has been coming into the U.S. This is going to continue, just at a bit of a slower rate, just given where things have balanced out, and you've seen some of those demand increases in Europe, which is why you've had that nice drop off, and now we're going to start to go sideways a bit at this at a more normalized level. And the reason why is because we're going to continue to see fuel oil, which has moved up. There's going to be some of this recracking, which is going to draw down some of that fuel oil, put it into the gasoline pool, and kind of shift where some of these movements have been as they take down some of this fuel oil from both Asia and the Middle East. So now when we look at Singapore, Singapore continues to see a build in products, which is what we were talking about. It went from 50.3 to 51.2. The builds were driven by middle and light distillate. Resid has been fairly flattish, but here's where what we've been saying, where we expected to kind of go sideways for the most part. Not taking out the highs, but again, kind of working as there's that competition between some of the India recovery, some of the additional slowdowns within the within other parts of Asia. So then when we look at middle distillate, as we were saying, we're going to get a strong bounce off that 15-year low, the 15-year average. Here it is, right at this level. So that's where we continue to see some of this movements, and now we think that there's going to be a continuous trend higher, especially as we have those shifts coming from the teapots and what they're allowed to import. Light distillate, as we were saying, is going to continue to move up. But if you look at that 15-year average, it's concerning because it's having a counter trend build, and it really speaks to, again, some of the softness that remains within the Asian markets for that driving demand. So then when we look at Brent time spreads, obviously the time spreads remain very elevated, but they've started to normalize a bit. And this is something where we think they're going to continue to normalize and even come a little bit lower, not back to where they were prior to the breakout, but again, still starting to see a bit more of this normalizing movement, some of these levels getting pulled down. And as we look at Brent, WTI and Brent December time spread, you can see, we're still at the elevated levels, kind of making a little bit of a top, but Again, there's a lot of this impact kind of back and forth as to where these flows are, where we're going to see some of these levels, and that's where we think there's going to be a bit of a pause here. And it comes down to the strength of the spread. What is the cure for high prices but high prices? And that's where, as these prices remain elevated, buyers will go elsewhere. There still remains enough crude in the world, and it's fungible. It can all go into motion. So as these spreads increase, you're going to start to see individuals go elsewhere to find those crudes, or you just won't run at the same level as we see crack spreads continuing to come under pressure. Margin pressure continues to come through. There's only one piece of four that remains in positive territory, but once you factor in storage and shipping and OPEX, you're pretty firmly negative across the Singapore space, which is just leading to the strength in spreads, the weakness in demand, and just where some of this where the builds are. It's going to be hard to see them continuing to run at those levels as their hydrocracking margins are at seasonally adjusted, really, right on the all-time lows. So then you look at Urals margin, everything is starting to roll over, which is why Urals are starting to get a little bit cheaper, trying to keep their, movement coming through, which is why you're seeing a bit more naphtha move in, especially from the US, trying to make some of this replacements and these adjustments. Same can be said for the Med. You can see just how negative some of these things are and continuing to get negative, and it's pulling it all lower. And that's why when you look at that topping side, when you look at the Urals FCC refiner side, there's just a lot of pressure in terms of where some of these numbers are. And that's where once you start factoring, again, OPEX and storage and movements, we're pretty firmly in the negative territory as well, which is, again, going to lead to some of these slowdowns as the crude imports into China remain depressed. This is super tankers that are signaling will remain fairly low. This will start to reverse, but because I think a lot of guys were waiting for those import quotas, what were they going to be? They were 35% below what they were last year. So now that there's some clarity, you're going to start to see some of those movements back up. And this is where, when you look at the SOEs are currently sitting there at about, anywhere between 65 and almost, pretty much on the average 75%. And there's still more capacity to come on, which is why they wanted to push some of these teapots a little bit lower. They forced them to be true to the run rates, which is why we've seen that big spike. It's just there's going to be that pressure on the teapots just based on where pricing is, where those pressures are. And then when you look at just what the state-owned refiners are doing and how that's going to be essentially make way for some of those increases. So even though teapots got a cut, we expect to see the SOEs make up some of that, and then the rest of it get moved into the other regions, and only because you're going to see a drop of Chinese exports as the teapots don't have the same type of capacity to push into the global market. Now, when we look at Asian floating storage, it still remains elevated, still at those highs. You can see that, as we were saying last week, it's just going to stay within this fairly tight range as we go through the next few weeks, just because there's, again, those delays, those timing issues, and that's really now that we have some clarity with where teapots are, they can go out and start buying a bit more. Some guys started to preemptively do that. So that's why we saw some more in transit, and that's going to turn into just more showing up on the coast. Then when we look at North Sea, we see some normalization. Again, it's going to be fairly flattish. There's not too much up or down. We think it's going to continue to, maybe trend up a bit just because there's going to be some bit more of a timing delay. And now you're starting to see those spreads come into play, and that's going to trap some of that North Sea versus West Africa. So you're going to see North Sea Europe build a bit, and that'll pull in some additional West African, which is why we've started to see some of that West Africa start to move. Some of this went to Asia. Some of it is coming into the U.S. So we'll actually see some of this floating storage in West Africa come down and closer to that 5-year average. Then when we look at the Middle East, the Middle East remains fairly elevated versus, obviously 2017, 2016 on that market share side. But right now it's tracking really right where it was in 2020. There's talk of an increase of 500,000 barrels additional when they meet, because by the time we get into July, the increases for May, June, July, but then what happens in August? And there's talk of another increase of 500,000 barrels a day, just given where the market sits and where they have for spare capacity. Europe, this is the one that we think is going to turn back up, and it's that timing. Floating storage came down, onshore storage went up. Now this is just the timing side, and we're going to have some of this more. We're going to have more storage coming through, especially because we have the pipeline coming back, spreads working against it. So we expect this to continue to move closer to the 5-year average, which typically has a drop right now, but really trending back up. Now, when we look at kind of where things sit at the moment, here you can see China Shandong crude in terms of where things are. Even though they haven't been importing, you can see that we still remain at these massively elevated levels. And the same can be said with just general fuel stocks, which remain at seasonally adjusted, really all-time highs. But not the highs for 2021. And that this is going to adjust because fuel oil exports were given additional export capacity where gasoline and diesel weren't. So again, they're going to see more of an increase in fuel oil, less of an export of gasoline and diesel. Now, when we look at refinery run rates, and this is the Chinese part that we just wanted to touch on. So China crude versus refinery runs, the crude available and the refinery runs are starting to get back up, but you can see just how elevated they were throughout this time period. So there's still that spare capacity that they're going to try to work through. It's just it's just a matter of who's going to work through it, the state-owned or the teapots, and they want the state-owned to have some of that capacity. And that's why when we look at where things sit in general, you can see just where the movements are on the U.S. versus other. So when we look at just the crude capacity, so U.S. operable refinery capacity is actually back above where it was in China. So because of the shift in China and the increase in the U.S., we've actually seen the U.S. take over again for the most activity in the world versus China. Now, that's temporary. You'll start to see some of that normalize, but it just speaks to some of the problems that remain within the Asian market. Now, that is also coming down to China has awarded the 35.24 million tons of crude oil import quotas in the second batch of issuance for 2021, about 35% less than last year. The figures which came to officials who received notification are down sharply from 53.88 million in the same tranche in 2020. So you're going to see, again, that cut. That's going to force some of those run cuts. The move will impact the pace of oil inflows into the so-called teapot sector, which accounts for a quarter of the nation's processing capacity. So some of that capacity just won't come back. Some of it will get picked up by the SOEs. Some of those runs will increase, but that's going to provide some of that adjustment and again, weigh on where some of this crude is inherently going. The Chinese teapot sector in 2021 began 2021 with a significantly larger first batch. Numerous delays in the second and latest batch, however, prompted them to hold back, and China awarded independent oil refiners 35% less. That is about 130 million barrels of less crude oil being brought to the Chinese independents, with some of that being made up by the SOEs. But that's where you can start to see some of those shifts in terms of U.S. operable and then the U.S. crude inputs. So again, you're starting to see some of those shifts because crude oil inputs came down, U.S. went up, and you're starting to see some of those balancing acts as China continues to struggle to normalize. And this is looking at it a little bit differently because China emerged as the top global crude oil importer in 2017 and is the #2 crude oil consumer behind the U.S. So here you can see U.S. crude imports, China crude imports through 2019, and then here you can see kind of where things sit as of 2019, which has since reversed. Temporarily, it's not a big change, but again, it's something to think of as we go into a market that is confused based on where the U.S. is and where Asia is right now, and Asia continuing to be kind of that overhang in general. Now, China crude oil imports and fuel exports. So net crude oil imports, when you look at the domestic, you can see just where they sit as of right now in terms of some of those import side. Then refined product imports continue to drop. But then when you look at just where those Chinese total refined product exports still remain elevated, and even though we expect them to come down in June, as we've been talking about, just given some of those new shifts, there's still going to be some of that excess versus previous, because they still have that export market. They still want to be kind of the U.S. side of Asia where they want to export. It's just going to be a bit different because the SOEs are going to be doing more of it, less of the independents in general. But then when you look at Chinese crude imports dipped as teapot stayed on the sidelines. This will come back, just not to the same level as we've been talking about. And then when you look at shunning imports, Shandong-based teapots refined the least imported oil since March of 2020. This is going to start to come back as well, but it just shows some of these overhangs that we've seen since April. And then when you look at the India, you can see India in general, month over month, when you look at the exports, they continue to see a big increase in exports on the diesel and gasoline side, as their imports for total still remained very low and their exports remain elevated. And when we look at just India gasoline exports, they're back above that 5-year average. But more importantly, on the diesel side, they're at a new seasonally adjusted all-time high. And this is where we continue to see some of this pushback, because India is exporting more. There's some of that demand is coming back. It's still some overhangs, especially on the diesel side, which speaks to some of that economic weakness that we expect to remain within the system. And then China is shifting. So we're seeing a lot of movements in Asia, which is really increasing some of the veracity or velocity of these changes in spreads in the global market. But as things start to shake out and we start to understand a bit more, I think you're going to see a bit more of a normalized level increase in imports into the U.S., a decrease in exports, and that's where we're starting to see some of these movements in general over the next few months. Next few weeks into the next few months. So if you have any questions, I know we covered a lot, some of it a bit more technical. Happy to answer any questions that you have. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.